Hey guys, the Investing Panda here. In this video, I'm going to show you how to read through the key financial metrics of a stock. In this case, we're going to go through Apple. I'm going to show you what I look for, what the different numbers and key metrics mean, and how to navigate a page like Yahoo Finance to get important financial information on any stock you're interested in. So here at the top you have Apple, ticker AAPL. The ticker is just a symbol utilized to signify every single company. So in this case it's AAPL for Apple. This is the price of the stock. This was at close March 26 at 4 p.m. It closed at 121.21. So this is the price of a share as of March 26. This is the amount that it gained on Friday, which is 62 cents. Or 0.51%. So here in the summary tab, it gives you a brief snapshot of the stock. So it gives you a lot of information on the price. So the previous close, so the day before it closed at 120.59 cents, which plus the 0.62 cents adds up to 121.21. Here's the open, the bid, which is the buys, ask, which is the selling price. Remember that the market is made out of bids and asks, or buys and sells. This was the day's range, ranged between $118 and $121. The 52-week range is the range of the stock price in the last 52 weeks or in the last year. So you can see that in the last year, the stock has traded as low as $59.22 and as high as $145.09. And currently, it's about $121, which is about 10 or 15% below its 52-week high. The volume is the number of shares that were traded on that day, and on Friday, about 94 million shares traded. And here's the average volume, which is about 111 million shares. So you can see that the volume was below the average. So Friday was a little bit of a quiet day for Apple. The market cap is an important metric. The market cap is the size of the company, and it's easily calculated. It's just the share price of the company times the number of outstanding shares. So if you have 10 shares at $100 each, the market cap for that company would be $1,000. The PE ratio is an very important metric that is used in the investment community to value a company. So the PE ratio means price over earnings. So it's basically the stock price divided by its earnings. And as you can see here, the stock price is about 32 or 33 times the earnings, which another way to put it is if you buy the stock at its current price, it would take the company based off of the earnings in the last 12 months, it would take the company 33 years to pay you back your money. Now, it's not perfect, and I'm sure for a company like Apple that's always increasing revenues and profits, it will take less time to pay you back, but that is nevertheless a metric that is looked at in the financial community. This is one of the methods of evaluating whether a price is too high or is low. So if we go to Y charts and we look at Apple's PE ratio, here you can see that in the last 5 years, the PE ratio has traded as low as about 10. Goes to all the way up to 19. There was a drop in 2019 back to 12. And since then, it's been going up, all the way up to 40. All the way up to 41 or 42 times. And as you can see here, it has been going down to where it is right now. So you can see that the stock is based on price to earnings only, is a little expensive. So in the last 5 years, the minimum has been 10, which was in 2016. The maximum has been 41, and the average is 19. So you can see that, and right now it's 32. So you can see that it's more expensive than the 5-year average. EPS means earnings per share. So this is the earnings in 1 year per every single share that the company has. So you can see that we can calculate the PE ratio and get to this number if we do an easy calculation of the price divided by the earnings in the last 12 months. And you get about 32.8, just like you do here. And that's how you calculate the PE ratio. Here are the earnings dates. Here's the dividend and yield. A dividend is a cash payment that companies make for every single share that they have, or every single share outstanding. In this case, the dividend is currently at 82 cents per share, or 0.68%. Nothing exciting, but Apple is a dividend growth company, meaning that it is increasing its dividends year over year at a higher rate than other companies are, which means that this yield will go up. As you can also see, this is pretty important, especially if you're a dividend investor, that its current dividend of 82 cents is more than met by its earnings of 3.69. So its earnings are way higher than the dividend, so it can easily make this payment and there's no risk of this dividend going away. So if we scroll down, you have some news and some articles about Apple, other stocks that people look at. We go here, you can see a bar graph of the company's revenues and earnings. So you can see that in 2017, its revenue was $229 billion with earnings of $48 billion, and it went up in 2018 to $265, and earnings went up to $59 from $48. Then you see a small decrease in revenue from $265 to $260, and earnings from $59 billion to $55 billion. But it picked up in 2020 from $260 to $274 billion, and from $55 to $57 billion. So overall, you can see that Apple is a pretty consistent company, and with time, it is growing its earnings as well as its revenues. In recommendation trends and recommendation rating, here, this is a summary of the analysts and who follow Apple, who evaluate the financials, who follow the company, look at the economic outlook, look at how the company is performing and its earnings, etc. And they come with a conclusion of whether the stock is currently a strong buy, a hold, or underperform or sell. So as you can see here, that in the last 4 months, there's been about 11 analysts who declare Apple to be a strong buy. An analyst and the buy portion of this has actually been increasing. So 16, 19, 20, and 21, or 21 analysts believe that Apple is a buy, and 6 believe that it is a hold. So analysts come up with these opinions based off of where is the stock trading at, what have been the latest revenues and earnings. So they evaluate the company, they also evaluate the economy, what is the price that it's trading at, and then they make an opinion or a conclusion on the company. You can see that on average, the recommendation rating is a buy, which is good. You can also see that these analysts have the stock prices at an average estimate of 152, which is their price target. This is where they believe that the stock is going to go. So you can see that the range can go all the way down to 83 as well as 185, but on average, the price that the analysts believe Apple stock is going to hit is 152. In this section under upgrades and downgrades, we continue on with the analysts and the different financial companies who evaluate the stock. So here the latest change has been on March 16th, 2021, and it was from Evercore ISI Group, and they changed to outperform. You can also see that on March 10th, Wedbush changed their opinion to outperform. And on January 28th, D.A. Davidson changed their opinion to buy. If you scroll down lower, you'll find the company profile, including its information like address, phone number, company website, the sector that it's included in, full-time employees, and a small profile on what the company does. So that's the summary page for you guys. So let's go to the statistics page, which is one of my favorite ones and one of the ones that I look at the most when evaluating stocks, because it holds a plethora of financial metrics that are pretty good to get a sense of the financial health of the company. So starting off with the financial highlights, here's the fiscal year end. So the fiscal year ends on September 26, 2020. So you can see that Apple's fiscal year ends in 2020 and September 26 and not December 31st. That's why it's called the fiscal year. Most companies have it in December 31st, but Apple has it in September 26. That's when their 2020 year ends. Profitability, you have profit margin and operating margin. Profit margin is the percentage of profit from sales. So it is basically the net income or earnings that you have after you have paid all expenses divided by sales. So here you see that the money that Apple is left over at the end of the day, after all expenses have been subtracted from its sales or revenues, you'll see that its earnings make up 21% of its sales, which is a pretty nice profit margin actually. Its operating margin is very close at 25%, and you'll notice that it is a little higher than profit margin because in operating margin you exclude things such as interest or such as tax, because operating margin is supposed to tell you, okay, how is the company operating, and what are the operating margins of the company, meaning that operations alone, without taking into consideration any tax or interest, how much money is the company making based off of its business alone, and excluding other things like interest and tax. Profit margin includes it all, and that's why it's a little lower, because this number is after you exclude things like taxes. Taxes don't really tell you anything about the business or how well the business is operating, right? Taxes are taxes, and they're going to be subtracted from the company if the company makes any profit at all, and that's why other profits like operating margin exist, which excluded to see how efficient the company is in managing its resources. So the higher this number, the better. So the higher these numbers, it means that the more cash or the more profit the company is producing, and the more profit the company is producing, the more profitable it is, and the better investment that it is, right? Management's effectiveness, you have return on assets and then return on equity. So return on assets is exactly what it means. It's the net income over the total amount of assets, and you'll notice that the net income makes up 13% of its assets, and return on equity is 82%. Now this number is a lot higher because equity, you arrive to this number by subtracting liabilities from assets, and then what's left is the equity. So you usually want a positive equity because it means that the company has more assets than liabilities. Liabilities can be debt or current obligations that it has. So you can see here for Apple, return on assets is 13%, return on equity is 82%. The income statement. So the top line is revenue or sales, which is $294 billion. Here's the revenue per share. You get here by dividing $294 billion by the number of shares outstanding, which is 16.7 billion, and you'll get to $17 per share. Quarterly revenue growth year over year is 21%. So this is showing you that the quarterly revenue growth is up 21% from a year ago, which is pretty good. Gross profit is $104 billion. And again, gross profit is just the sales minus costs of goods sold. So it doesn't take into consideration anything else, anything like overhead or payroll or marketing expenses or taxes or depreciation or any of that. It's just the gross sales minus the costs of goods sold, or the costs that you need to incur to create or produce the product that you sell. Ebitda means earnings before interest, taxes, depreciation, and amortization. So this is a really great number to look at. It's very much used in the financial community because Ebitda is a good number that tells you how the company, again, is operating. Ebitda are the earnings of the company before you subtract interest, before you subtract taxes, before you subtract depreciation, before you subtract amortization. So depreciation and amortization, or the DA of Ebitda, these are accounting figures, so they don't really tell you how the business is operating. It's just a method used in accounting to depreciate an asset. So let's say you buy a piece of machine for $1,000 and you think that the piece of machine is going to last you 5 years. You would depreciate the $1,000 machine over 16 months. So you would divide 1,000 divided by 60. So you would depreciate $16 every single month for 5 years, and then you'll depreciate the entirety of that machinery over its useful life in 5 years. So as you can see, it's an accounting measurement. So financial analysts like to remove that. They like to remove amortization, which is very similar to depreciation. They want to remove taxes and interest because those things do not give an indication of the earnings that Apple is able to get before paying for taxes and interest. So Ebitda are the earnings that Apple is able to earn from its sales before it pays for interest and taxes, depreciation, and all of those things. Next, we have the net income AVI to common. So I really don't know what this one is, to be honest with you. Diluted EPS, quarterly earnings. So it's the quarterly earnings growth over as compared to a year ago. And you can see that it has grown this quarter by 29% as compared to last year's quarter. So this is pretty good. You can see that quarterly revenue growth was 21%, quarterly earnings growth was 29%. So you can see that the company is growing both revenue and earnings by a similar amount. The balance sheet gives you a snapshot of what the company looks like in terms of its assets and liabilities and the health of the company. So total cash or liquidity is $79 billion. So that is a lot of cash. Cash per share is $4. And the total debt is $112 billion. So this is quite a bit of debt, but you can see that Apple has more than enough cash to cover almost all of it. Its total debt over equity. Remember that equity is assets minus liabilities. And this formula has debt over the remaining, or equity, and it's 169. Debt over equity is a measurement of how the company is financing operations. Is it doing so through selling more shares to the market, or is it doing so by taking out debt? So as you can see here, it's doing so by taking out more debt, which makes sense because interest rates are really low and a lot of companies are doing that as well. So Apple is making the decision to finance operations, to finance research and development, partly by taking out debt, because it believes that the cost of that debt to pay it back is going to be less than the cost of providing shares out. So they believe that their shares are going to go up and that they'll be able to pay out their debt. So the current ratio measures the company's immediate liquidity, meaning, does the company have the ability to meet its short-term obligations, or to pay off all of the obligations that it has to pay out, all of its bills, all of the money that they owe their vendors, and to pay out short-term debt. As you can see here, that the current ratio, or its current assets or short-term assets, are 1.1 times short-term debt and obligations. So yes, it is liquid, and it is able, if all of its vendors and its debtors say, I need you to pay me today, they would be able to do so and have some left over. The book value per share is really an accounting metric. Some people use it, some people don't. Again, with accounting metrics, things are a little different. But here you can see that it's 3.94, which could make the company seem uberly expensive, as it is trading at $121. But the book value per share is just, it's an accounting measurement of saying this is what the company is worth based off of its book value. So it'll be the assets minus depreciation minus its liabilities, etc., etc. So this metric is not really used by many. I don't really use this often, to be honest with you. Cash flow statement. Operating cash flow means the cash flow that Apple is able to produce on its normal day-to-day operations. And you can see that on a normal year, Apple is making about $88 billion in operating cash flow. So the levered free cash flow is the free cash flow that the company has after it has paid out all of its debt, all of its obligations. So you can see here that it is $66 billion, which is less than the operating cash flow of $88 billion, which makes sense because here they have paid for obligations and debt. Trading information, so the stock price history. So here you have the 52-week change, which is 90%. So from a year ago, it has gone up 90%, which we're on March 28th. So that's about the time that we had the crash in the market because of the COVID fears. So it makes sense that if you would have bought then, you would have made 90% return on this stock. The 52-week high is 145, 52-week low is 59, which we talked about this. The 50 and the 200-day moving average. So the moving average are metrics used by some, and it tells you exactly that, what the average was in the last 50 days. So the last 50 days, what was the average price? And it usually takes into consideration the closing price of the stock. So in the last 50 days, the moving average was $125 per share, and then the 200-day moving average is $122. And you can see that it is currently below both of them. So you can see it either that the price of the stock is underpriced, or that it is bearish, or it's going to continue to move lower. So depending on how you look at this, if you look at it from the perspective of a fundamental investor, you may say it's like, okay, the price is below the 50 and 200-day moving average, so it is cheaper than the 200-day moving average, so maybe this is a good time to buy. Or if you're a technical analyst, you're saying, it's below this mark. If it continues to be below, there's a high probability that it's going to continue to go down, so maybe I should short sell the stock, which I wouldn't recommend you to do. I've actually bought some Apple at about 119, 120 since it's gone down from the peak. But again, Apple, in my humble opinion, is not cheap yet, but I have bought some now just in case it doesn't go any lower. But if it does, I'll be ready to buy some more. Here's the share statistics. So the average volume in the last 3 months has been 110 million. This means how many shares have been exchanged. So you can see this is a huge number. 110 million shares have been on average changed each day for the last 3 months. And then the average volume in the last 10 days have been 113. So slightly above the 110, meaning that there has been a little more activity in the trading of Apple's stock than in the last 3 months. Shares outstanding is 16.79 billion. These are the number of shares outside of Apple's possession. So 16.79 billion shares are held by retail and institutional investors currently. Percentage held by insiders is very minimum. You can see that by institutions. Institutions hold about 60% of the stock. You'll see this with large caps, etc. So institutions, we're talking about Fidelity, Vanguard, we're talking about mutual funds. So these are funds that are investing the money for pensions, for retirement accounts, etc. Shares short is 107 million shares. Short ratio is 0.89. You would short a stock or a share if you believe that the company's price, its earnings, its revenues are going to go down. So the way that shorting works is that you borrow shares from someone else and you sell it at the high price, and you're expecting the price to move lower. So once it does, you buy them right back at a lower price. So you spend less money, you give the shares back, and you make the difference. But as you can see here, there's not a lot of interest in shorting Apple, as it is a strong growing company. So let's go to dividends and splits. So you can see that the forward annual dividend rate is 0.82 cents, and the forward annual dividend yield is 0.68%. So this is looking 12 months ahead, and then the trailing annual dividend rate and yield is looking 12 months back. You see that the 5-year average dividend yield is 1.42, which is much higher than the current 0.67, and that's probably because the price is more expensive. So as the price goes down, the dividend yield will increase. So the payout ratio is an important thing to look at as an investor, especially as a dividend income investor. And for Apple, it's currently 21.77%, which is really good. And the reason that it's important is because it tells you the current dividend, how much of a percentage is it out of the total of earnings. So if it was 100%, it would mean that the company is paying out all of its earnings as dividends, and that would be bad because then there's no profit left over for the company to reinvest in itself. Also, it's really bad because it means that the dividend will probably never go any higher because there's no room to grow. So at 21.77%, there's room for this dividend to grow all the way up to 60 or maybe even 70% over time. So that tells me that if you invest in Apple today, yes, the dividend will be low at 0.67%, but with time, the payout ratio can grow, increasing this dividend to 1, 1.5, 2, or even 3%. So the payout ratio of 21.77% means that the dividend is 21.77% of its earnings, which means that 80% of earnings are left for the company to reinvest in itself. Here you have other information as dividend date, etc. So those are the metrics and the statistics, guys. So this is how to look at a stock utilizing Yahoo Finance, or you can utilize another website like Google Finance perhaps. You'll notice that a lot of the same statistics and financial metrics are also there. You'll find a lot of the same information. So if you're looking at stocks and you want to get an idea, okay, what should I look for? What do all of these metrics mean? This is how you do it. In another video, I'll be showing you how to read the financials. So next video, we'll go through the income statement, the balance sheet, and the cash flow. So stay tuned, guys. I hope this video helped you. I hope you liked it. If so, please subscribe to the channel and smash the like button. I really appreciate it. Take care, guys. Happy investing.